What's up, y'all? It's Lester Palmiano from Minotaur Capital Advisors here. This is our second video of our series of how to get a larger refund when filing your taxes. In our first video, we went over a W-4 and the contents that's within W-4 to help understand withholding. That's what your employer holds as your taxes to pay to the government. Think of your W-2 as your end-of-year statement for your employers that breaks down different numbers such as how much taxes did they withhold, how much is your taxable income, and other items such as what was your health deduction or what was your 401k contributions and so. Before we move forward, I just want to remind you to subscribe now. The content we are creating, we want to make sure that it's helpful for you with your NKG strategy. And remember, that's make money, keep money, and grow money. This whole series is all about keeping your money. I want to make sure you keep your money in your pocket because this is money that you've earned. And by understanding your taxes a little bit more, hopefully you too are able to get a larger refund. With the first video, we were able to provide a high overview of tax withholding. Now we want to dig a little bit deeper into that and give you an understanding of how that withholding is calculated, because that's the number that the employer is going to withhold. So a number of factors and variables go into the tax withholding, and that's what we're going to go over today. Your tax withholding and how it's calculated is determined by several factors within a tax bracket shown here, and that includes your salary. It also includes your tax filing. Your tax filing means if you're single, married, or head of household and such. In addition, your percentage that you pay for each salary bracket. The tax bracket, or this tax table, is created by the IRS to simplify how much you need to pay on your income. Looking at this tax bracket, you'll notice that on the top is your filing status, and that ranges from single filers, married, filing jointly, qualifying, surviving spouse, married, filing separately, head of household. On the left side of the column is your tax rate, but your tax rate is based on the salary, based on each filing status. What you're seeing here are the 2023 tax brackets. Let's look at this tax bracket in a very simplistic manner. Let's just say you're a single filer and in 2023, you made $5,000. So your tax rate on that $5,000 is 10%. So of the $5,000 that you made, you will pay 10%, which is approximately $500. And in another example, say you made $11,000 as a single filer. Well, your $11,000 is subjective to a 10% tax rate. You fall at the same bracket as that person who also made $5,000. In another example, you made $25,000 as a single filer. Your first $11,000 is subjective to that 10%. Anything over $11,000, that $14,000 is now taxed at the 12% tax. That's going to be your tax liability that you owe to the government. This is the number that your employer will withhold from you throughout the year. If you're a single filer and you're making $100,000 a year, up to that $100,000, you may think that you have to pay 24% on that whole $100,000. And for $100,000 salary, that range is, according to this bracket, your first $11,000 is going to be subjective to 10% tax. Above that, $11,001 to $44,725 is going to be subjected to 12% tax. The numbers between 44,726 and 95,375 is going to be subjected to 22% of tax. The remaining 95,376 to $182,000 and $100 is subjected to 24% tax. And you could see here the math and how it's calculated. What I just also want to remind you that this tax bracket, depending on your filing, you could just follow along this table and kind of have an idea of what your taxes may be. Those are some simple examples of how to calculate your salary. Taxable income that's in your W-2 is already subjected to things that your employer already adjusted, such as things like your health care or social security taxes, or possibly your 401k or retirement investments. Now you understand how your employer calculated your withholding. Now when it's time for your tax filing, what you want to do and the strategy of what you're trying to do is make your taxable income number lower. When you start creating deductions such as investments in an IRA that could help lower your taxable income, after those calculations are created and deducted, what's left is your adjusted gross income. Your adjusted gross income is now the number that the IRS will utilize to calculate your taxes. And if your tax liability is lower, that means you have to pay less taxes. If you've already paid your taxes, that means you will actually get money back in the form of a refund. And there's other ways to lower your tax liability, and that's through credits and deductions. And we'll get to that in our next video. We'll go over through some examples and definitions of what are credits and what are deductions, how would it lower your taxable income, and what ways and in what means can you file your taxes, maybe even possibly for free. That concludes this video in which we went over the tax bracket. And in the tax bracket, it utilizes your filing status, your salary, to find out how much percentage of taxes you must pay, and in essence, how much taxes you're gonna have to pay or be liable for. I'm hoping you took the information that I provided you today as helpful. If you did, please, again, I want to remind you to please subscribe now. If you subscribe here, we'll be able to put out more and better content that helps you make money, keep money, and grow money for your MKG strategy. But until next time, please stay tuned for the next video as I go over through credits and deductions. Thank you so much for your time, and see you in a bit.